Okay, so let's talk about the Canadian mortgage market. Specifically, how the Bank of Canada's kind of surprising new inflation outlook, well, it's shaking things up for borrowers and what we expect with interest rates. First, the Bank of Canada, the BOC, they're seeing way less inflation than the bond market is right now. BOC Deputy Governor Riz Mendez pointed out that while investors are looking at core inflation, that's inflation without the jumpy stuff like food and energy, at around 3%, the bank's own number crunching puts current inflation closer to 2.5%. Now, that half percent difference, it's actually a really big deal because it gets the BOC much closer to its 2% target. Second, this lower estimate gives them a lot more wiggle room for potential rate cuts down the line. The BOC's main policy rate is sitting at 2.50% right now, so that 2.5% inflation number means they could justify some pretty decent cuts, maybe even bringing the rate down to 2% or less, which kind of lines up with what we've seen in past rate cut cycles. For you, the borrower, this makes variable rates look pretty attractive for the lowest overall cost, if you can handle the ride, the potential ups and downs. Finally, and this is probably the most important bit of advice for anyone getting a mortgage, focus on what you can actually afford, not the maximum the bank says you can borrow. Lenders, yeah, they'll offer you the biggest loan possible, but you need to figure out a budget that works for your long-term finances, making sure things like retirement savings and just, living comfortably are covered. That's how you protect yourself from that rate roller coaster we just mentioned. So the BOC's changing view on inflation is definitely shifting the conversation towards rate cuts, making variable rates tempting, but being smart and cautious about affordability is still absolutely key.